This is a video on measuring investment return brought to you by PolarisInvesting.com, website for creating defensible valuations. Well, to get started, I'd like to discuss an investment club from a town in western Illinois called Beardstown. And the investment club later became known as the Beardstown Ladies because it consisted of 16 or so older women, all 70 years old or older. And they made a claim that they had achieved a 23.4% annual return over the previous decade. And this got the attention of a book publisher. They published a book in 1996, which on the cover made that claim. The book sold over 800,000 copies. Well, soon after the book was released, an article was run in the Wall Street Journal. And the writer for the article had hired Pricewaterhouse to review the investments, and they determined that the actual return was 9.1%, dramatically underperforming the S&P 500 index during that time by almost 6% a year. In the article written by the Wall Street Journal writer, he did say that the math was so complicated that he had to enlist help of financial experts, namely Pricewaterhouse. Now, we'll be talking about later that it's not that it's so complicated, it's this basic algebra. What it really is it's nuanced, that you've got to be real careful about what's considered a return and what's considered just an asset or an investment. But the story does demonstrate that most investors just don't have the financial skills or patience just to take a little bit of time and learn what is actually involved in calculating an investment return, nor do they take the time to identify tools that, even if they do. And what happened with according to the story, the Beardstown Ladies, is that they did use a software to enter in their data, but they incorrectly entered the data, so they don't even have the skills to use the financial tools properly to determine correct investment returns. Well, an interesting side note is even once the article in the Wall Street Journal was written, the women went ahead and published a follow-up pocket guide book that sold over 200,000 copies, and they went on tour doing over 200 investment workshops a year around the country every year for several years. So that is an interesting side note. It brings up a whole another set of issues around just kind of human behavior, and it's odd that even though a claim that was made was really proved later on not to be true, these women were continued to held in high regard in terms of their investment prowess. So you wonder how many people out there who are incorrectly calculating their financial returns, investment returns, are just ignorant of the reality that they're not making the kind of return that they think they're making. Well, let's talk a little bit more about the supposed complicated math that's involved in calculating an investment return. What the Beardstown Ladies did is they just assumed it was just a straight up percentage. You look at your account where you're keeping all your investments, and you look at the end balance, you compare it to, you do a percentage gain over the beginning balance, subtract 1, and that's your, if you do that on an annual basis, that's your annual returns, and then you do an arithmetic average of those returns, and voila, you got 23.4%. Now on the surface, that doesn't sound too far-fetched, but you'll see here as we get into a little more of the details that, again, it's the subtleties involved that make a big difference. So the first thing when you're calculating an investment return, you have to have a clear objective as to what are you trying to measure. And over the last couple decades, the objective of investment returns has come down to really two main objectives. Either you're trying to determine how the investments, the assets themselves performed, or you're trying to determine how an individual investor, along with their decisions of when to buy, when to sell, or decisions around cash flows, how they performed. So is it investor return or asset return? Another way that the asset return is discussed is really fund manager performance. Fund manager doesn't have control over when contributions and distributions are made by his investors. So a different type of return called geometric return is calculated to determine how just the assets are performing in the fund. Geometric return is also called time-weighted return, or maybe it should be called time period weighted return. Time period return computes a separate return for each time period. It is assumed cash flows occurs at the end of each time period. Reinvestment is accounted for by increasing the size, aka number of shares, of next period's beginning investment. Period returns are linked together by calculating a geometric mean. This makes the size and timing of cash flows only relevant in the period they occur in. Just to make sure you understand the math behind the geometric return, showing here the return in a given period, M, is the price plus the cash flow that's being recognized in that period at the end of the period, divided by the investment or the price at the beginning of the period, minus 1. To link all the returns together, you add 1, do the same thing for each preceding period. Notice you need to know the price of the stock at the time of each cash flow. Then you have an accumulation factor over the entire duration. Now, looking at the math, breaking this down, you can see that a lot of things cancel out, and you end up simply with, over the entire duration that you're measuring a return for, simply the price at the end of the duration divided by the price at the beginning of the duration. And then you can take whatever geometric power you want to, in this case N, but you can do M periods and then calculate a geometric mean across N. Since cash flows occur intermittently, M and N are typically not the same. M is determined by when the cash flows occur. N is typically set to compute an annual rate of return over the duration covered by the M periods. To show that this N and M do not have to be equal, this table up here demonstrates when they are equal, both 10, you get a geometric return of 1%, assuming these values here over the left. Over here though, let's say you have just M equals 2 and you still use N equal 10, you still get 1%. But you are basing it on 2 periods, each covering 5 years across the duration of 10 years. Here you're using 3 periods. One is just 1 year, another one is 6 years and 3 years. So even the length of time in each period doesn't have to be the same, but you do need to span the same duration that you're calculating the geometric mean for. The second objective is how the investor is doing. And that's calculated using internal rate of return, which is also known as dollar-weighted return or money-weighted return. And it takes into account actual timing and size of cash flows along with how the assets are performing. It's focused on really whether the investor is attaining their investment goals or not. Spending dividends is an example of how investor timing decisions can have a significant impact on wealth. If an investor is receiving dividends from their stocks and they're choosing to spend those dividends versus reinvesting the dividends over a long period of time, that apparent simple decision to routinely distribute cash from the portfolio will result in an enormous difference in accumulated wealth. The internal rate of return is also impacted by the compounding effect of reinvested dividends. But a fund manager performance is not impacted by an individual investor's decision to reinvest dividends or not. A fund manager performance uses the geometric return, in which all cash flows, including dividends, are explicitly accounted for by computing a return whenever a cash flow occurs. Individual stocks have cash flows, namely dividends. Other assets that may be in a portfolio, like bonds, have coupon payments, but you get the idea that assets have cash flows. And then if this is all rolled up in a portfolio, then the investor themselves create cash flows by contributing money for new investments and taking distributions. So take it all the way back to the Beardstown Ladies investment club. If their objective was to be an investment advisor, and then they should have reported a geometric return, which would indicate how the assets performed that they recommended. If their goal was to show that they made good decisions around their portfolio, and then it should be measured by the internal rate of return, because it's more of a overall portfolio performance at that point. If it is assumed cash flows only occur at the end of the time period, and therefore cash flows are not reinvested during the period. This is simply like the Beardstown Ladies were assuming when they calculated their investment return, is that you put money in and receive no cash during the period, and at the end of the period you calculate a return. And if you may want to load up with some more investment, but then you measure return at the end of the next period, but there's during the investment period that you're measuring return for, there are no cash flows, then the internal rate of return and geometric return, and therefore fund manager asset returns or portfolio investor returns, are the same. But then again, this is only true if there are no cash flows during the period, and therefore no cash flows are reinvested during the period. Well, now with the understanding that it's easy to make mistakes when measuring investment return, let's move now to a little more of the details. And I know this looks kind of busy on the surface, but we'll just quickly go through it. I'd like to focus your attention on the left side of this picture. And what we're seeing here is a timeline for just 2 years out. And then during that 2 years, we have two hypothetical portfolios, Portfolio 1 and Portfolio 2. Assuming here in Portfolio 1 that the portfolio is made up of two stocks, Stock A and B. Same thing for Portfolio 2, Stock A and B. And the only difference between these portfolios is the timing. Now, internal rate of return accounts for both timing and size. Size, this means the amount that you're buying or selling, or the amount of size of dividends. But just going to focus on just the timing aspect and the measurement difference that you get just from timing. So the only difference between these two portfolios is the timing. In the first portfolio, you're buying stock A here right at the beginning of the life of the portfolio. 1 year later, you're selling it for $150. You do the very simple percentage math, 150 over 100, you get a gain of 50%, but the ratio is 1.50. Stock B, you wait a year, 1 year out, you invest $1,000, and a year later you have $1,050. So you do the math and you get 1.05. Now, if you take 1.05 times 1.5, and then take the square root of that, or to what's shown over here, the geometric return, is you're multiplying all the individual returns that you've measured, and then taking it to the nth root. And since we're only doing 2 years, that's the square root. Well, you get a geometric return of 25.5%. So it's saying for Portfolio 1, the average, or kind of a uniform rate of return that's earned across the 2 year time frame is 25.5%. Now let's compare that to Portfolio 2. So instead of buying stock A right at the beginning, stock A is now delayed. The purchase is delayed a year, but the same amount is purchased, same return is made. And then instead of delaying a year to buy the stock B, it gets bought here initially at time 0, and then 1 year later. Well, you do the math, you get the same percentage gains in the 1 year periods, and you multiply these together and take the square root, you get a geometric return. So you have the same geometric return regardless of the timing of when things were done. But then the internal rate of return is also shown here, and you can see here that the internal rate of returns are quite different. So it really boils down to what's the objective? Are you trying to measure how the assets performed, or are you trying to measure how the investor performed with the decision of when to make the buys and the sells? Well, here at the bottom it shows the formula that's used in calculating an internal rate of return. Now it's interesting to note internal rate of return really wasn't very feasible to calculate until the 1700s, and then there was a technique, a general mathematical technique created called the Newton-Raphson method of successive approximation that at least made it possible to calculate, make the calculation in a reasonable amount of time, but it's still very labor intensive. But here in the last couple of decades, with advent of computers and availability of programs that do this calculation, it's very straightforward in today's environment to calculate an investment return. But like with the Beardstown Ladies, they had the software even back in the mid-90s, but they entered the data incorrectly. The mistake they made is they entered their annual dues as investment cash flows as opposed to new contributions or new investments that were made throughout the life of the portfolio. Now, the big thing with investment return or internal rate of return that you need to keep in mind is that let's take example the stock B in portfolio 2 is that you invested. It's assumed that a stock was purchased for $1,000, and then 1 year later you had it was sold for $1,050. But the portfolio continued on for a whole nother year. So we're measuring return across a 2-year period. And the question is, well, what's to be assumed about what happened to this $1,050 in the second year? So what the result of this internal rate of return calculation, which is, by the way, just looping around and discounting back, trying out different internal rates of return until you end up with the sum total of all the present value of all the cash flows equaling 0. So when you make an investment, it's considered a negative amount, and then when you get money back, it's considered a plus amount. So you're trying to determine what internal rate of return gives you a present value of 0. Well, back to the example I was giving where you bought this stock B for $1,000, you sold it a year later. What happens here in the second year? Well, the internal rate of return algorithm assumes an opportunity cost. It assumes that whatever resolves to this equaling 0, that and let's say here in the portfolio 2, 8.8%. So what you're assuming is that even though there's no explicit indication of what was done with the $1,050, it's assumed that this $1,050, if had stayed in the portfolio, would have continued to make 8.8% in the portfolio. This assumed opportunity cost is also referred to as the reinvestment assumption. This opportunity cost explains why the internal rate of returns is different between these two different portfolios, because here in the second portfolio, $1,000 was invested right here at the beginning of the portfolio. So it's been in the portfolio for the whole life of the portfolio, 2 years. So for that amount of money to be in the fund and for the fund to end up where it did, it must have a lower rate of return as opposed to this portfolio 1 where that relative large amount relative to the rest of the portfolio wasn't invested until the end of the first year. So it was in the portfolio half as long. So therefore the rate of return that was achieved on the overall portfolio is higher. Compare that to the geometric return calculation where you have here a starting investment of $100 and at the end of the year, that investment is valued at $150, either from pure appreciation or from a end of year cash flow like a dividend. And then you do it for every period, and like I talked about before, then you just take the geometric average, which is the nth root, or in this case 2. So now the question, let's return back to the Beardstown Ladies. What if the goal of their, or objective of their communicating with how they performed was to just say how their assets performed, then they would just simply have reported 25.5% return on the investments that they made. But most investment clubs, the big part of it is their decisions around contributions and distributions, and moving, buying and selling different stocks, and then seeing if the overall, I mean, that's why the women got together as an investment club. They wanted to better their position and financial position, and so it would be more appropriate for them as an investment club to communicate an internal rate of return, and then depending on what their decisions were around stock A and B, they would either have reported 9.4% or 8.8%, and that's pretty much what got them into trouble. Again, is that they counted their annual dues, where they paid around $25 a month each for a total with about up to 16 women in the investment club. They got up to around $4,800, $5,000 a year, or $400 to $500 a month. So they had a lot of recurring contributions on a monthly basis. But again, they just counted all that at the end of the year as just being part of the overall return that they earned on their investments, which was the error that they made. Now that we have a common understanding of the two basic types of ways of measuring return, and why you would do one versus the other, and how those two methods are actually calculated, I'd like to review the Polaris Investing.com website and the two tools that are provided by Polaris Investing.com to make sure we understand the investment returns that are being used in those different places. So first of all, up here on the website, when you've decided you're going to lock in this particular practical investment return, you add it to your plan. Then when you come up here and you look at your investment plans, you have a target return. Well, what is that? Well, that's just simply a expected forecasted return over the next 5 years on an annual basis. There are no cash flows. It just assumes that if you decide to go forward, you're making an investment up front, and as long as you keep that same dollar amount invested over the next subsequent years, it's forecasted you'll make, in this case, 0.4% return on your money. So going forward, there's not the complication of forecasting and looking forward. There's not the complication of cash flows. It's just simply make this investment, and here's the forecasted return that Polaris website is calculated for you. Well, PolarisInvesting.com does make available two tools for you to use. And I'm going to scroll down here down the launch page and see if you go out here to the download. The two tools are called the Portfolio Return application and the S&P 500 Analyzer app. Now there are several videos out on the PolarisInvesting.com YouTube channel. I invite you to go watch if you're not familiar with these applications. I'm going to assume that you're somewhat familiar with them. Well, the portfolio return, let's talk about them individually. The portfolio return app is kind of at the other extreme of what happens on the PolarisInvesting.com website, which again is a forecast going forward for each individual stock. The portfolio return app was created so that you would know in retrospect, looking backwards, as to what you actually ended up doing, what your investments were, the cash flows of each one of those investments, and then what the overall internal rate of return was for your portfolio. So just a quick reminder of what that application looks like is that here I brought up a portfolio, and this just consists of two stocks. The actual cash flows of these stocks, there's buying on a certain date, and then there's dividends received, and another buying on it. But you can see here that, yeah, the internal rate of return can take into account all these different times of things occurring, and not requiring that everything line up on certain annual dates and have a very simple calculation. And then you can see all the cash flows that occur with dividends between these two stocks, and then you end up with an overall portfolio return that's measured with an internal rate of return calculation of 16.9%. But you see individually that the two stocks have had quite different internal rates of return over different periods. One has been around for 3.1 years, and the other one's been around a little bit less. But still, you're able to come up with an overall, in retrospect, looking at the actual decisions that were made by the investor and the actual cash flows that occurred, with the rate of return that was earned over the last 3 years. Okay, another tool provided by PolarisInvesting.com is called the S&P 500 Analyzer app, and its purpose is somewhere in between. Instead of looking strictly forward at individual stocks, like the PolarisInvesting.com website does, or looking strictly backwards at the actual decisions and such that were in cash flows, which the Portfolio Return app does. This app is really designed to kind of be in between, where you can use it more for tactical planning, where you're moving from what you decided to target up on the Polaris Investing website, and you can start building out and seeing from a portfolio view. If you were to, let's say here, buy 100 stocks of General Mills, and you were to buy 100 shares, or sorry, 100 stocks of 100 shares of General Mills and 100 shares of Microsoft, what the targeted, coming from the Polaris Investing website, what the targeted go forward rate of return would be, and then the roll up would be a portfolio view. Now I'm going to diverge for a second. I'm going to go back and I want to talk about the portfolio calculation, which is shown in the right column here in the bottom, where portfolio expected return. Now the key word there is expected return. It's primarily this calculation, which most people are familiar with, which really is just a weighted, you weight the return of each individual stock. So for example, here I own, this example is showing that we're going to, once you account for the price times the number of shares, that your portfolio will consist of 70.5% of Microsoft and 29.5% of General Mills. So when you calculate the overall portfolio return, you're doing a weighted. You're taking this percent times the return, this percent times the return, added up, and you get 5.9%. So when we go back and look at the formula, that's the weighting that most of us were taught in calculating a portfolio return. But what's often forgotten is that the way you get to that result is you got to realize that it's assuming that you have some basket of stocks. At the end of the year, you add up the value of the basket of those stocks, and the baskets at the basket of stocks at the beginning of the period. And that's kind of back to what the Beardstown Ladies did. They had individual stocks, and they probably remembered this formula, that it's just a weighted of the individual returns. But again, it assumes that there's no cash flows in between the ending value of a basket of stocks and the beginning value of a basket of stocks. And you can see here that, at the end of the year, you're just summing up the asset values of each asset that makes up the portfolio, and then here at the end, you're just summing up what, or at the beginning, you're summing up the value of individual assets that make up the portfolio. And so what's lost is in between this result and what the portfolio really is, return is designed to measure, is that in order to get the weighting, you're taking each asset's value at the beginning of the period divided by the total basket's value at the beginning of the period, and then you're multiplying it by the end of the year asset value divided by the beginning of the year's asset value, which is the 1 plus the rate of return earned on the asset. And then this number here is the weighting. So it is based on no cash flows in between the period that you're measuring the return for. And so back to this works when you're kind of in this intermediate state using a tool that will give you some idea of going forward. And that's why I'm stressing here that this portfolio return is primarily an expected return, meaning that if you were to buy the stocks as shown here and going forward, you would make 5.9%. Now also shown here on the S&P 500 Analyzer app here in the watch list area is a price change and then an overall portfolio price change. Now we got to realize that the price change that's being calculated is based on historical price compared to the current price. Now the historical price uses not just the price of the stock, but what's called a adjusted close, which takes into account dividends that have been received between the historical date and the current date. Also, stock splits can be accounted for by dividing historical prices by the split ratio. Adjusted close calculation is shown up here to the upper right, and it's based on the concept that only historical prices are adjusted for dividends. So the idea behind adjusted close is we want to take the current price and divide it by an adjusted close number to calculate a return over a specific period. Well, let's look at the relationship between a historical adjusted close and the current price. And that's what's shown here in this formula. And the way we can think about it is this adjusted price, when it's multiplied by a return that we had between n minus 1 year ago compared to the minus n, the return during that period. So you want to look at the starting value, the net cost of that stock in years ago. So we're assuming on the day of a dividend, the net cost was whatever price was paid minus the dividend. And right before the next dividend is the price at the end of that period. Dividing the end of period value by the beginning period value is the period return. And then you just keep doing that every period, where a period starts when a dividend is paid and ends right before the next dividend. You multiply all those together and then take it times whatever the adjusted price was back on 10 years ago, and it'll equal the current price. This formula is showing a constant D throughout time, but wherever you see a D, that could be a D specific to that time period. Now, if D turned out any time period to be 0, let's assume even all these D's are 0. What you would see is that the numerator and denominator would cancel out all the way through, such that you would just end up with the period return just being the current price divided by the price in years ago. Well, if we take this formula and just divide both sides by adjusted close in years ago, we get this second formula, which is the period return that we're looking for. Now, instead of going through this right side of the equation every time we want to calculate the period return, that includes dividends, what we want is just to be able to use the current price and divide it by a pre-calculated number, which is the adjusted close. Well, look at the bottom here, under this note, calculating for A minus N, you can calculate what A minus N is. And also you notice in this formula that you can cancel out P of naught, which is the current price. So now you only need to recalculate these adjusted closes on the next dividend. And if you have a stock that doesn't pay dividends, then A minus N is always the price in years ago. But this is a very convenient way to calculate a return that includes dividends going back to any date. So it's really the dividends that cause the subtlety that you have to keep track of that when you're dealing with this kind of roll-up portfolio return, that these stock returns here are based on adjusted closes and therefore represent geometric returns. You can't just simply take a portfolio weighted average is incorrect, because you're not dealing with expected forward-looking annual returns. You're now dealing with historical geometric mean returns. And so the only way you can get this number is to also calculate a geometric mean return which is correctly done in the worksheet. But if you're wanting to use the portfolio return formula and apply it to these two individual stock rate of return, you will not get 0.56% return, because that's not the right method to calculate that. So the best use of this column here in the S&P 500 Analyzer app is to only go back a short amount of time. This tool is really intended to kind of start building out your portfolio, comparing it to the S&P 500, and looking forward to what the overall expected rate of return is. Look backward a little bit. Maybe it's primarily intended to just look, what the current price changes are, so you can tactically kind of see if whether there's been a big move in the stock recently. So by default, you're always looking at the previous trading day in terms of how far back you're going. But the further back you go, the more likely you're encountering incorporating dividends in the overall return being calculated. So maybe half a year, you can get reasonable indication of the overall return that you've earned over that last year. But when you start going back 2 years, 3 years, 5 years, it's best to just use the portfolio return application that does the calculation using the internal rate of return. The other thing about this spreadsheet is it assumes that the start date of when you purchased everything is the same. So unlike the internal rate of return algorithm used in the portfolio return app, which can account for different dates of buying and selling, this spreadsheet assumes everything is done on the same date. All right, so let's recap so we all have a same understanding. The Polaris investing website is primarily for strategic planning, to think about what target rate of returns you want to shoot for, and you end up with individual stocks with each with their own specific target rate of return going forward for the next 5 years. At the other extreme is the portfolio return application, which is more about assessing and looking back of how your actual portfolio performed. It takes into account your collective investment decisions, deposit withdrawals, cash flows, dividends received, things like that. Now, in between those two, strategic planning and assessing from a historical perspective is a kind of a segue tool here called the S&P 500 Analyzer that gives you both a little bit of looking forward around a portfolio, and it also gives you a little bit of looking back, maybe 1 or 2 months back at most, and gives you an idea of what recent performance is. But really, you're just checking recent performances. You're thinking through how much you want to invest in terms of individual stocks that make up your portfolio. And just to drive this home, I'm going to briefly go through side-by-side example. At the top of this picture is shown the portfolio return application. In the middle here is the watch list from the S&P 500 Analyzer app, and then down here to the left is the cash flows that are actually in the portfolio that you would see in the portfolio return app. You can see here at the top of the portfolio return app, you get the exact internal rate of return for General Mills of -2% over the 3.1 years it's been in the portfolio, 32.3% of Microsoft return for the 3 years it's been in the portfolio, for a roll-up of 16.8%, which is calculated using the internal rate of return. Now, here in the watch list, we're assuming, even though the actual cash flows, one was bought General Mills on January 7th of 2016, and Microsoft on February 16th of 2016. The S&P 500 Analyzer app all uses a common date for any historical view. So pick the earliest of the two dates. So that's a little bit of a difference already that you're going to see between these returns. And then, as mentioned earlier, these are now geometric returns, so they're not going to be exactly even compared to the internal rate of return that was calculated. And then the roll-up number is a geometric return, but it's not going to be the same as exactly the same as the internal rate of return. And the further back in time you go in the S&P 500 Analyzer app, the more these numbers are going to diverge from the portfolio return application. So if you're assessing historical performance, use the Portfolio Return app. If you're planning ahead, use the website. If you're thinking through weighting and how much you want to invest in individual stocks, and as you're doing that, you want to look at kind of what recent performance has been around those stocks, go back at most 1 or 2 months, then use the S&P 500 Analyzer app. All right, to wrap things up, I'm going to go back and look at what we started with, and the Beardstown Ladies story is just kind of a cautionary tale that you got to you got to be real clear of what you're trying to accomplish when you're measuring investment return. It's not so complicated that as we went through it, it's just more, as I've said earlier, it's just that there's just subtleties and nuances involved, and you just got to be clear about what it is you're doing at any given time. Be clear of the objective. Are we measuring the manager of the fund's performance? Are you measuring investor performance that includes their buy and sell decisions? First case, you're using geometric return. The second case, you're using internal rate of return. Also important to understand the cash flows, and are you properly indicating whether it's an inflow or an outflow in terms of the overall cash flow? Is it part of the investment, or is it a result of the investment? All right, thanks for watching.